welcome. It's Michael Murray with Benzinga, joined here once again virtually by Henry Schwartz, the Vice President, Global Head of Client Engagement, Data, and Access Solutions. Henry, we were able to join you in person in Q1 to talk about the options market and get some insights from Cboe at their VIX pit in downtown Chicago. So very excited to be chatting with you again virtually. Thank you for joining us.
Good to see you, Mike. Thanks for having me.
Always great to chat with you and Cboe Global Markets and get insights for our retail investors and our traders out there in the markets, get the market education that you have to give. Let's kick things off today talking about a recap of the first quarter of 2023. Lots of headlines, lots of exciting news, and a lot to digest. So can you give us a recap of options flows specifically and what you saw in the markets in Q1 here?
Sure. Yeah, it kind of seems like there was a sea change between when we last spoke and now. We were kind of, last time I saw you on the floor, we were talking about, what a record-breaking year 2022 was, and how 2023 had kind of started off a little bit more traditional, right? We were starting to see hedgers come back. We were starting to see kind of two-way flow a little bit more than we had, right? Coming off of those really heavy retail years for 2020 and 2021, and then the 2022 down market. So 2023, as you and your viewers know, we've had a little banking crisis, right? So we had the Silicon Valley Bank, for issue kind of come out of nowhere for a lot of people. Of course, in hindsight, there's plenty of analysts that'll say, "Oh, this was easy to expect given the speed of the rate hikes," but I don't think most people were looking at it. When you had some of these stocks, that were trading, Silicon Valley Bank was I believe it was $130 stock, and then it was a $40 stock, and then it was a $0 stock, and that fear of it was a little bit of a reality check, I think, for a lot of traders who were kind of like, wow, banking requires trust, and runs on banks happen, and then all of a sudden the Fed gets involved, and you have a lot of angst over, especially going into the weekends, right? Because that happened over a weekend, and then I think it's been 5 weekends since, and Credit Suisse was also an implosion that kind of happened, although albeit it was only it was a low dollar stock to begin with, but you had a lot of turmoil come out in this financial sector, and it had a lot of traders scrambling, and now it feels like we're kind of on the tail end of that now. Things have calmed down, but certainly March, the first quarter has been really, really strong in terms of volume, right? So we're seeing increases across the board. Single stock up a couple percent, ETF up, and index up sharply. And that kind of goes along with what I was saying, last time I saw you, which is, we're just seeing a broader use case for options than kind of what we've had in the last couple of years. But when you get into this shakeup, specifically in the financial sector, that creates all sorts of dynamics where people are getting out of the sector. You get other people jumping in, speculating, kind of taking advantage of some extreme moves and extreme option prices. So it's been an exciting month for sure.
No doubt about that. And let's go into a little bit more detail on this exciting month, right, and everything that was going on. Let's talk about maybe the biggest headline of Q1, and especially the last 30 to 45 days, the recent banking crisis, Silicon Valley Bank, and everything that happened in the financial sector. How did that banking crisis affect the options market? What insights can you give us here?
Well, there were a couple of really interesting things, right? One was volatility in a handful of these banks, especially these regional banks, these kind of lower tier banks, exploded as the stocks were just getting creamed. You had a lot of traders basically looking around for anything, any similar banks, basically kind of mid-tier, not your mega cap, Citibank, J.P. Morgan kind of banks, but things like First Republic and some of the New York area banks, Signature Bank. So traders were scrambling to try to find this whole sector basically where there could be a lot of stress, where you could have kind of some implosion, death spiral kind of dynamics. And so for option traders, basically especially those stocks, they sold off very hard. Volatility exploded. You had options. There's always kind of stories people tell, like, oh, there was this option that went from 80 cents to $90 in a day. Well, we had some of those situations, and so that creates a lot of interest, right? Everybody's trying to understand, how does this work? And they're actually looking for a similar kind of opportunity, which is obviously very, very hard to find. But one of the other things that was really interesting in those, especially, was Silicon Valley Bank halted for about a week, and it was into expiration. And so you had a lot of confusion about what happens to a put. If you're long a put and the stock is effectively kind of imploded, you should be happy, right? That's how you make money, owning a put. Except that then all of a sudden there were big questions about, well, wait a second, how does exercise work into expiration when the stock itself is halted? So it was actually, it reminded me of kind of some of the dynamics that we noticed in 2021 and 2021, particularly with the meme stock craze. Some of these outliers, some of these situations that really aren't, they don't happen very often. They're not really handled in anybody's options pricing models. What happens if you own an option and the underlying halts for a week? That's not in the Black-Scholes. So, and all of a sudden people start scrambling, and they're calling OCC, they're calling the exchanges, saying, "Wait a second, I don't understand how this works." Then there were some, there were some headlines about, even some of the brokerage firms didn't quite know what to do. I think in the end, OCC clarified how it all works. But people had to know, it was an example where people really have to understand what they're doing, right? In those cases, the automatic exercise because you have an option in the money is actually turned off by OCC. So the brokers do a good job in contacting the customers and saying, listen, this is different this time. You need to actually tell us what to do. But it definitely created some confusion and some concern among some traders.
Absolutely, that's a great way to put it. And let's talk a little bit about some of the implications from some of that. Can you provide any insights into the implications from the indices and the market signals that you're seeing a little bit more on the technical side? But what details would you give to any retail investors watching this unfold as well?
Well, I mean, to me, a big shakeup like this is always a good thing, because you get people, you get some irrational activity, right? You get people trading because they have to trade. You get people trading without putting a lot of thought into it. So any sort of real market disruption is an opportunity for traders that have been disciplined, have some dry powder, aren't overextended. Okay, that's why it's really important to kind of behave that way when you're trading. What we saw is, there was a flight to quality. So people were dumping these names, these financials, these banks that they considered to be a little risky or have the potential of a bank run, and they were pouring their money into the big banks, the J.P. Morgan, the Chase, the Bank of America, and so, which are also just banks, right? And in the end, a bank, a U.S. bank is the deposits are guaranteed to a certain amount by the FDIC, and that's it. But whether it's a kind of low quality bank or a high quality bank, but you had a whole ton of capital kind of moving from certain stocks into kind of what people would consider the safer, the blue chip style financials. And for traders that actually were thinking about that and could kind of see what was going on, I think there was opportunity, right? There was certainly opportunity to look at options and say, well, are these options implying the higher payment for risk that that the market is kind of starting to assign to all these financials? So, and then really to look ahead. Okay, how do you think this is going to play out? And some of the, it's hard to pick single stocks, right, and do the research. But fortunately, there's a lot of ETFs out there that cover kind of almost every segment you can look for. So traders can kind of make their judgment in terms of which way they want to lean. But then then they can use options, calls, puts, spreads, and structures to kind of set up a payoff profile that matches their expectations too. So,
Outstanding. Okay, so Henry, along these lines too, many investors, of course, have heard of the VIX index, but they may not have heard of the SKEW index. Can you talk a little bit and explain what the Cboe SKEW index is, and more specifically, why might a retail trader want to reference that when considering different trading strategies, especially in this environment?
Sure. So you're right. VIX is a well-known term. They call it the fear gauge. Plenty of news coverage mentions it, whether they understand exactly what it is or not, right? But that basically tells you the level of volatility. It doesn't tell you a lot about the expectations that the market has for direction, right? Like higher volatility cuts both ways. We can run up higher, we can have larger swings to the upside, larger swings to the downside. That's what a high VIX tells you. SKEW, and Cboe has an index called SKEW. SKEW, it tells you kind of the way I think of it is the probability of going down versus probability of going up, and it's not a symmetrical distribution. Markets behave different ways at different times. You can have crashes to the downside. You can have super strong run-ups to the upside. In general, the index typically shows a little bit of a higher probability to the downside. Okay, that's called a positive skew. That's normal. The SKEW index itself lets you watch that over time, so you can see basically how the expectations are changing. So when there's a lot of fear, we know volatility goes up. But there are days where the market's going up and the volatility also goes up a little bit, okay? And people kind of go, oh, that's kind of weird. SKEW is another dimension on this, which is it's effectively telling, it's based on the price of an out-of-the-money put versus an out-of-money call for a similar delta. And like I said, usually they'll put a little bit higher in volatility terms, so you have a positive skew. But that moves around, and basically people use this as a sentiment indicator, so that when they see skew steepening up, that's to me that's actually more indicative of increased fear and increased concern about a downside move than simply just looking at the VIX and seeing it go up. Because when the VIX goes up, it's not necessarily telling you people are concerned about a downside move. It's just telling you that the market is anticipating larger moves.
Fantastic. And what kinds of strategies are we seeing traders use in this environment? And what products might we see them using it? Again, great insights on Q1 and all the headlines we've seen here and all the things that have affected the way the markets are moving. What kind of strategies are you seeing traders use, and what products specifically might they be using to carry those out?
Sure. So the kinds of swings that we've seen, we're seeing plenty of directional trades. People committing some capital to an outright option purchase. We're also seeing vertical spreads. We're seeing lots and lots of complex order activity, and part of that is because the exchanges have evolved to handle complex orders in a much more efficient way, and the brokerage platforms have made it even easier for customers to enter and exit spreads as a unit. So you don't have to worry about buying one option and selling another. You enter the trade as a spread. You can put the limit in as the limit applies to the entire structure. You can set your stop loss. We see that a lot, especially in the 0-day options, which we talked about last time. This is a new phenomenon. They're not actually listed on the final expiration day. They're listed almost a month until they expire, but they are listed every single day. So I think it's more accurate to call them dailies than 0 days. But the activity in the 0-day options, and now these are in the major products. Okay, SPX is the biggest one, and that's where the 0-day options make up 40 to 50% of the activity. So we're talking 1.5 million contracts a day. But there are also 0-day options in some of the other products, SPY and Q and Nasdaq, and XSP and on the Cboe as well. And so what we're seeing in those products is a lot of systematic approaches, even by retail traders, which to me is really surprising. It's kind of a new use case. But we see traders basically kind of mathematically defining what they're going to do, and then using these 0-day options to express that view, enter the trade. From what I can tell, that most of the participants are very disciplined about it and kind of have their profit target and they have their stop loss target. They need to understand how that really works in the market, because there are dynamics that can make things behave, kind of unusually. But what we see is people becoming much more comfortable with that, and this continuous flow and a lot of coverage about it, right? Because people are talking about it. They're saying, well, I can't believe you're seeing, this kind of activity in options that are only 6.5 hours until they expire. But we continue to see it. We continue to talk to the participants and ask, why you're trading this and how. And one of the most interesting things I heard at a meeting with some investors was that they're using some of these 0 days just for really specific directional bets with a kind of the defined risk nature of an option, right? If you buy a call, you can only lose the premium on the call. Same thing if you buy a put. And with the cash settled index options like SPX, it's ultra simple. I mean, there's a settlement price at the end of the day, and you get cashed out versus that settlement price on any options that are in the money. So it's an easy product to get used to, and it's because it's there every day and it's very, very liquid. You kind of have this two-sided market that is creating enormous amounts of volume.
Phenomenal. Henry, as always, every time we get the chance to talk with you and Cboe Global Markets, we walk away with insights for the retail investing audience, always helping us break down what's going on in the markets, especially here with all the headlines in the last few weeks. We're going to be back with you and your team on site at the Cboe Old Post Office location in downtown Chicago for another on-site interview coming up soon. Henry Schwartz, thank you as always for joining us.
Awesome. Thanks a lot.